Tom Halverson, thank you for being with us once again for the latest installment of commentary on COVID-19 and its impact on the economy. You know, one of the many difficult challenges of this crisis is that the government's economic policy response on the fiscal side to make the short-term impacts of the crisis better also create longer-term problems. And we wanted to kind of start there. I want to show you a chart here that shows the latest estimates from the Congressional Budget Office on the annual deficit of the U.S. government. And the projection for 2020 is $3.7 trillion. What say you to this number?
Well, clearly we are in an unprecedented situation. And when you are with your family and your house is being blown down by a Category 5 hurricane, you're going to go out and use the credit card and access whatever financial resources you need to survive the event. That is what the United States Congress and the White House are doing together through the legislation that they have passed. We are, if we lose 25% theoretically of our output in 1 year, that's $5 trillion worth of GDP lost, right? We've spent, $3.5 trillion-ish, maybe more, of fiscal stimulus already, maybe more to come. So we're trying to keep the economy from going off a cliff as we address the COVID-19 pandemic. And while in the short term, this is what you have to do, no one can debate that. In the long term, one of our big challenges was that we entered the COVID-19 crisis with, on the one hand, a really strong GDP growth and great macroeconomic indicators, but our fiscal position was already very poor and very vulnerable. And now we've had this shock, and we are having to dramatically expand our deficit and therefore our government borrowing, which means that we're pushing in front of us a dramatically bigger fiscal imbalance that's going to make our future choices after the COVID-19 crisis has been worked through, that's going to be really challenging for us to deal with.
Let's go to the next chart, which also shows, is updated with CBO projections, but it shows total debt of the federal government as a percentage of GDP over a long time horizon, going all the way back to World War II. Analyze this chart for us, and what does it portend?
Well, this is a distressing chart. As a banker, I look at a borrower whose fiscal position, changes this negatively at such an accelerating rate, and I got to ask some questions. What's going on here? And it should distress us all, I think, quite frankly, that our debt levels are the same level or about the same level they were after 5 years of World War to vanquish Nazi Germany and the Empire of Japan. What have we borrowed all this money to achieve? Well, we could debate that, but it wasn't a matter of national survival over recent years that got us into the weak and vulnerable fiscal position that we were in pre-COVID that has now been exacerbated dramatically. The fiscal consolidation that will be thrust upon us either by voluntary behavior or by the markets at some future date is a reckoning that we will have to deal with, but we have to wait until we get through the pandemic before we start to address those choices.
Let's go to the last chart that we wanted to bring up, which is related, and it shows inflation over a long time horizon, I think going back to the 1970s, as reflected in the Consumer Price Index. Inflation is always a fear, I think, when the government starts to spend too much. That's a fear that you read about in the media and that people have. You also hear, conversely, worries about deflation. And I wonder if you could maybe just demystify that, and which of those scenarios are you more worried about right now?
It's a great question, and people of my generation or older have a experienced set of inflation in their mind. If you look at that graph, way back in the early 1980s and further, we had big bouts of inflation, and that was a very meaningful experience for people. But as in between the two devils of inflation on the one hand and deflation on the other, We have a lot more experience with the inflationary devil than the deflationary devil. But you know how to deal with the inflationary devil. And frankly, it's a lot easier to deal with based on historical experience. It's less pernicious and hard to fix than deflation. Deflation is really, really, really worse than inflation. It's very hard to correct. There's lots of experience in this in other countries over long periods of time. And right now, our big problem is we have a collapse of aggregate demand, which means asset prices and prices for everything other than some select commodities are falling, which is the pressure of deflation. And so thank goodness our Federal Reserve, they're very smart and they understand exactly that how difficult and dangerous it is to get out of a deflationary spiral. And they're doing everything they can as a monetary authority to prevent us from falling into the death spiral of deflation, which is very hard to exit. However, that doesn't mean that the steps that they are taking do not mean that we will just flip into an inflationary spiral on the other side. Because the way the economy of the United States and the way the economy of the world works today versus in the 1960s and 1970s is dramatically different. We are a much more open economy. There is much higher levels of trade and interdependence in the world economy. And because we have so diversified our supply chains and trading relationships around the world, that has greatly dissipated the ability to generate inflation in the economy of the United States, right? Because nobody has any pricing power in the United States because you can always replace most things with a product made in China or made in Mexico or made in some other location. And so I am not particularly concerned about any inflationary spirals anytime soon. I expect interest rates and inflation to remain quite low. To me, the biggest potentiality in the medium and longer term for us to have inflationary challenges will come from choices we make now. If we decide to start to disentangle and onshore lots of our industries that we've offshored over the last 25 years, we will start to recreate some of the conditions that create bottlenecks and allow for inflationary pressures to emerge in an economy that is more inwardly oriented and less internationally interdependent.
Last question. Is it the case that if we get into a higher inflation type of situation with all the government borrowing that we've done, that the constraints on the government to do things other than service debt becomes a real problem?
No question. I mean, the fact that we can remain calm with a budget deficit of this magnitude, which is totally unprecedented, is a function of the fact that absolute interest rates are so low. They're effectively zero. We can borrow, the United States government can borrow 10-year money at 60 basis points, which is effectively free for all intents and purposes. And even though the budget deficit has exploded and our debt is growing rapidly, the debt service cost as a percentage for the government is actually falling. The reason for that is because the interest on the debt is falling faster than the stock of debt that we owe is growing. So we have to be very sensitive to the sustainability of our debt dynamics based on the conditions of interest rates, because you're absolutely right. Our debt stock and our fiscal position and our budget deficit would become immediately problematic if interest rates rose to any meaningful or material degree. It takes a long time to get yourself into the kind of situation that we've gotten ourselves into, and it will take a long time to get ourselves into a more sustainable position. But the longer you wait, the more challenging it becomes.